Hello everybody and welcome to Ask a Fund Manager. Today is August 2nd, 2020, and the question I'm going to address is the dollar on the verge of collapse? Is the US dollar dead as a reserve currency? I've been getting asked this a lot by viewers and followers of mine, and my take on it is mixed. I think on an absolute basis in terms of purchasing power, the series of actions of central banks will weaken the currency. And we've seen that already through what's going on with gold prices and with other commodities such as oil rallying and even Bitcoin breaking above 10,000. However, versus other currencies, the story is a lot different, and I will get into that why. But first, I think in the near term, a lot of the sentiment for the dollar is getting a little bit overly negative. You see Fitch on Friday downgrade its outlook from stable to negative on the U.S., which may be a sign of peak negative sentiment on the U.S. dollar. You've also seen Goldman Sachs come out with commentary saying that the dollar is going to have extended weakness. And you've seen a lot of the anti-dollar trades get overbought on a technical basis. But with that, I'm going to go into my theory on why I do not think that the dollar should materially weaken, at least from a fundamental perspective, versus other major currencies. There's always risk on and risk off sentiment that can cause the dollar to strengthen or weaken in the near term, just generally on people's attitude of risk. But from a structural basis, the picture is a little different. This is a chart from Yardeni Research that I got that they quoted from Havre Analytics. It shows all of the central bank balance sheet growth since 2007. And as you see, even with the recent action from the Fed, which is the red line, in the last couple months, it really just caught up to the ECB has been doing. And on a population adjusted basis, the Bank of Japan is still ahead. I mean, it's smaller on absolute basis, but in terms of on a per capita, since Japan is a third of the population of the U.S., it's actually a much larger expansion. I mean, the only one you really think that should maybe rally on a relative basis might be the RMB, but that is not really a free floating currency. The next chart I'm going to show is what is going on with the euro since that time period. The last time where that blue and red line were at the same point, the central bank of the ECB and the Fed had a similar sized balance sheet, was January 2017. And in January 2017, you had the euro trading around 104. Now it's trading at 117.74. So, and basically you've gotten the rally from the Fed's expansion of the balance sheet, but it's, I think, more than pricing in at this point the future weakness of a relative pairing of those sizes of the balance sheet. I mean, the only way really catalyst I think you would need to have that rate differential narrow is if the U.S. pursued negative interest rates, which parts of the bond market are pricing in. But right now, I just don't see it happening due to longer term consequences that it has in the banking system. And I also think that the solution for extended weakness in the economy due to COVID would be more on the fiscal stimulus side. As you've seen with the dollar on a shorter term basis, this is a daily chart, it's quite oversold. It's the last few times that happened, which was in January and in March, you've got a near-term bounce. I think that may be what happened because, again, I think there's plenty of reasons why the dollar and all fiat currencies should weaken, but versus each other, the argument is a lot more hollow. Longer term, this is a weekly chart. The dollar is not at oversold territory yet. It has been trending in a downward fashion, and it could continue to do that. And right now it's testing a key low in March. If you look at some of the anti-dollar trades, such as gold, this is a weekly chart of the gold, which is trading above its major moving averages. It's upper Bollinger Band and pretty deep into overbought territory. It's probably due for a correction in the short term. However, longer term, as long as you're going to have real rates remain low and or trending lower, a gold at a rate of 0 looks more and more appealing. And that's kind of my take on it. I think a lot of these anti-dollar trades, it's not really the time to get in now, but if you do see a rebound in the dollar, then you'll have your opportunity. I don't really talk about specific trades in these videos, but just more of a macro context. If you'd like to see more of these videos, please like and subscribe. Follow us. If you have any questions you'd like me to talk about, email me at askafundmanager@gmail.com or comment on the video. Thank you for watching.